In this video, we're going to use your Chapter 11, Question 5 homework to demonstrate terminal cash flows. So, to calculate the terminal cash flows, it's a several-step process. The first thing that you're going to do is you're going to calculate the book value of the new machine on the date of disposal. And remember, book value is cost minus accumulated depreciation. The second step is we're going to calculate the gain or the loss on the sale. By taking the proceeds from the sale of the machine, or the sale price of the new machine, and we're going to subtract the book value of the new machine. In step 3, we're going to calculate the tax, the additional tax, or the tax savings. We're going to take the gain or loss and multiply that by the tax rate. Then finally, in the fourth step, we're going to take the proceeds from the sale of the new machine, which is the sale price, we're going to subtract the additional tax on a gain, or we're going to take the proceeds from the sale of new machine and add back the tax on the loss. So in step 2, you're going to have a gain or a loss. It's going to be one or the other. So what's going to happen is, if this number in step 2 comes out to be a positive number, you have a gain. And if you have a gain in step 4, you would just subtract the tax on the gain. But if you have a loss, step 2 would come out as a negative number. So step 2 comes out as a negative number, you have a loss, and then you get a tax savings, so you'd add back the tax. So the first thing that we're going to do is we're going to calculate the book value of the new machine, then we're going to go through the problem step by step. So let me erase my drawings. And then let's go. So we're told in this problem, Lunar Industries is currently analyzing the purchase of a new machine that costs $164,000 and requires $20,100 in installation costs. So the depreciable cost of the new machine, we're going to take the $164,000, and we're also going to depreciate the installation costs of $20,100. So we're actually going to depreciate $184,100 over the useful life. So I'm just going to take $164,000 and add the $20,100 in installation costs. Purchase of this machine is expected to result in an increase in net working capital of $30,500 to support the expanded level of operations. Oh, and I forgot with the terminal cash flows. Excuse me. I'm glad I read that. Insert. And insert. So what's going to happen is the terminal cash flows is going to be your step 4, which is going to be the after-tax proceeds. Plus, you have to release your working capital. So you're going to notice here that this purchase of this machine required an increase in net working capital of $30,500. So supplies and employees. So we always assume that when we get rid of the machine, we fire the employees, get rid of the supplies, and we go back to where we were right before. So we're going to depreciate $184,100 over the useful life, and part of the terminal cash flows will also be that release of working capital. The firm plans to depreciate the machine under makers using a 5-year recovery period for the applicable depreciation percentages, and expects to sell the machine to net $9,800 before taxes at the end of its usable life, and the firm is subject to a 40% tax rate. So in Part A, we're supposed to calculate the terminal cash flows. B, discuss the effect on the usable life of the cash flows. C, assuming a 5-year usable life. And then D, discuss the effect of the sale price in your findings in Part C. So now that we know the depreciable cost, let's do our depreciation schedule. So because we're going to depreciate the machine under makers using a 5-year recovery period, we're going to bring up our table, and we're going to use that middle column, 5 years. So I'm going to put in my percentages. So we're going to have our year 1, 2, 3. Notice we go up to 6, 4, 5, 6. I know I could use the fill handle. So each year I'm going to put in the cost, which is going to be the $184,100. Each year I'm going to multiply the cost by its maker's percentage. So those are given 20%, 32%. I can't just write 32 in Excel. 32 is 3,200, 19%, 12%, 12%, and 5%. So the next thing that we do is we multiply the cost by the maker's percentage to calculate the annual expense. The annual expense each year adds to calculate the accumulated. And the last thing that we're going to calculate is our book value, which is simply our cost minus the accumulated depreciation. So for each year, all we have to do is multiply the cost of $184,100, the depreciable cost, which again is the cost of the machine plus the installation charges, multiply it by that year's expense. So the first year we have $36,820, and we see all of the different expenses each one of the year. So remember, year 1 is $36,820. Year 1 is the year 2 is the 36 plus the 58. Year 3, 36 plus 58 plus 34. Year 4, 36 plus 58 plus 34 plus 22. So I showed you how to do this in one formula. I'm going to type equals sum, open the parentheses, click on the first expense, type a colon, close it out. Going to click in the first cell and change it to an absolute cell reference. So I'm telling Excel to sum up, always start at the beginning, but to end at the cell that's one to the left of the current one. So 36,000, 36 plus 58 is 95. 36 plus 58 plus 34 gives us 130. 36 plus 58 plus 34 plus 22 gives us 152. 36 plus 58 plus 34 plus 22 plus 22 gives us 174. And then add the final year, we have an accumulated depreciation of $184,100. So now to calculate the book value at the end of each year, all we have to do is take the original cost, $184,100, and then subtract our accumulated depreciation, column E. So now we've done the first step. We've calculated our book value at the end of each year, and notice at the end of year 6, our book value is going to be 0. So we've done step 1, calculate the book value of the new machine on the date of disposal. Now, we're told that we plan to sell the machine for $9,800. So we have the proceeds from the sale of the new machine. We just need to know which book value. And we have a tax rate of 40% that we are going to use in this problem. So in Part A, we're supposed to calculate the terminal cash flow for a usable life first of 3 years. So if our usable life is 3 years, we're going to sell it at the end of year 3. So I'm going to highlight our book value at the end of year 3. Let me scroll down a bit. So our book value at the end of year 3, $53,389. So if you go back to the formulas that I gave up above, we're going to calculate first the gain or loss, our additional tax or our tax savings, and then calculate the after-tax cash flow. So now we've got our book value, so we're going to calculate our gain or loss, which is going to be the proceeds minus the book value on the date of sale. So in this case, we're told that we're going to sell the machine for $9,800. Our book value is $53,389. So notice it's going to come down to a negative number. I'm just going to follow the calculation. I'm going to take $9,800, subtract $53,389, and I get negative $43,589, which means that we made a loss. So notice, because our proceeds are less than our book value, we made a loss on the sale. So now, because it's a loss, we get a tax savings. And our tax savings are going to be $43,589 multiplied by 40%. The gain or the loss multiplied by the tax rate. Which gives us 17435.6, rounded to the nearest dollar, 17436. So now all we have to do to calculate the total after-tax proceeds is we're going to take the sale price, and because we had a loss, this time we're going to add the tax savings. So we're going to get $9,800. We're told to round to the nearest dollar, so our tax savings rounded to the nearest dollar is 17436. So if I take the $9,800 and add the tax savings, we're going to get a total terminal cash flow of $27236 from selling the machine. Then we're going to have to release the working capital, but it does not, and we're going to have to, release the working capital, so we'll get the total cash flow. So in this case, we have the proceeds from the sale of the proposed assets is $9,800. We're going to add back our tax savings. Our tax savings is $17436. We're going to have our total after-tax proceeds of $27236. Now we have to release back our working capital, so $30,500. So now to get our terminal cash flow, all I'm going to have to do is I'm going to take the 27,236 and add the 30,500, which is of course 57,736. Let me go back because that cell now has the wrong number. 27,236, add the 30,500, and now we have our total terminal cash flow, 57,736. Now let's move on to the second part. In part 2, we have a usable life of 5 years. So for a usable life of 5 years, I'm just going to hide these rows. I'm going to take away my highlighting. Now, if we have a usable life of 5 years, we're just going to sell it at the end of 5 years. So at the end of 5 years, our book value, $9,205. So we've got step 1. We've got the book value of the machine on the date of disposal. So we're going to take the proceeds, subtract the book value, calculate the tax, and then calculate the after-tax proceeds. So now that we have our book value on the date of disposal, we're going to do step 2, where we're going to calculate the gain or loss. And remember, if it comes down to a negative number, we have a loss. We take the proceeds, and we subtract the book value. So in this case, we're told in each case that we're going to sell it for $9,800. In this case, our book value is $9,205. So all I have to do is take 9,800, subtract 9,205. It comes out to a positive number, so we wind up having a gain of $595. Step 3 is to calculate the tax on the gain. Because it came out to a positive number, we know we had a gain. So we're going to take $595. We're going to multiply that by 40%, which is our tax rate. So we're going to pay a tax of $238 on that $600 gain. Now, in the last step, to calculate the after-tax proceeds, because we have a gain, we're going to take the sale price or the proceeds, and we're going to subtract out the tax on the gain, because you have to pay a tax on a gain. So in this case, we're going to get $9,800 from selling the machine, but we're going to have to pay a $238 tax. So we're going to net $9,562 from selling the machine. Remember, we're also going to have to release our working capital of $30,500. So together, we're going to come to $40,062 terminal cash flows. So for our second part, for the 5-year life, proceeds are going to be $9,800. The tax is going to be $238. So the total after-tax proceeds, $9,562. Then we add back the working capital of $30,500. And we're going to have a terminal cash flow of $40,062. Let's move on to the next part. So in part 3, if we use the machine for 7 years, it's just going to have a 0 book value. So anytime after 6 years, we've depreciated the entire cost through makers, and after that, we have a 0 book value. So we're just going to go through exactly the same steps. In the second step, we're going to calculate the gain or the loss on the sale. Oh, excuse me, I always like to put the loss in parentheses because then we know it's a positive number, it's a gain. If it's a negative number, it's a loss. So if you remember, we take the proceeds, we subtract the book value. So in this case, our proceeds stay at $9,800, but with a 7-year life, our book value is 0. So we're actually going to have a gain of $9,800 on the sale. We just carry the calculations through. In step 3, we have the tax on the gain. We're going to take our gain of $9,800, multiply that by 40%, $3,920. So then in step 4, we take the proceeds, we subtract the gain to calculate the after-tax proceeds. So in this case, we're going to take our $9,800 sale price. We're going to have to pay a $3,920 tax on the sale. $5,880, and remember we still have to release that working capital of $30,500. Add both of them together, 36,380. So proceeds from sale, $9,800, tax, $3,920, total after-tax proceeds, $5,880. Add back the working capital, $30,500, and we come out to 36,380. Now, in B, we're supposed to discuss the effect of the usable life on the terminal cash flows using your findings in Part A. If the usable life is longer or shorter than the normal recovery period, the asset has not been depreciated fully. So if the usable life is shorter than the normal recovery period or less than the normal recovery period, the asset has not been depreciated fully, and a tax benefit may be taken on there may be a loss, because if the book value is higher, therefore the terminal cash flow is higher. Let's move on. In Part C, assuming a 5-year usable life, calculate the terminal cash flow if the machine were sold to net 1, $9,205, or 2, $171,000 before taxes at the end of the 5 years. So all we have to do is resolve the problem in Part C. And in Part C, we're supposed to assume a 5-year usable life. So notice our book value at the end of the 5-year usable life, $9,205. So in Part 1, if we sell it for $9,205, the first thing that we're going to do is we're going to calculate the gain or loss, which is going to be the proceeds or the sale price minus the book value. So we're going to sell it for $9,205. The book value is $9,205. So we're just going to have 0 gain or loss. Our tax on the gain, 0 multiplied by 40%, which is 0. Then we take the proceeds, subtract the tax on the gain to get the after-tax proceeds. So in this case, we just take $9,205. Because we sold it at book value, there's no gain or loss. So we subtract our zero tax. So we're going to get net $9,205. And remember, we still have to release the working capital of $30,500. So in this case, $39,705, terminal cash flow. 9205, zero tax, 9,205, 30,500, and finally 39705. The next part, if we sell it for $171,000, and notice we're supposed to round to the nearest dollar, we're just going to go through the same steps once again. So the first thing that we're going to do is calculate the gain or the loss, which again is going to be the proceeds minus the book value. So in this case, I'm just going to take 171,000. I'm going to subtract 9205. Because it comes out to a positive number, that is a gain. Next step we're going to do is calculate the tax on the gain, which is just the amount of the gain multiplied by our tax rate. So I take the 161, $795, multiply that by 40%. Remember, we're supposed to round to the nearest dollar. And I get 64,718. Now to calculate the after-tax proceeds, we take the proceeds and subtract the tax on the gain. So in this case, I'm going to take 171,000 that I'm going to get, but I'm going to have to pay a tax of 64,718. So I'm only going to net 106,282 from the sale. Don't forget to release the working capital. $136,782. So 171,000 is the proceeds. We subtract the tax of 64,718. We net 106,282 from the sale. Add back our change in working capital, 30,500. Terminal cash flow, 136,782. Moving on, using your findings in Part C, what is the effect of the sale price on the terminal cash flow? And of course, the higher the sales price, the higher the terminal cash flow, because no matter what the tax is, the more money you get, you're still going to keep 60% of that money, even though you're going to pay 40% in taxes, so it's never going to go down when you get a higher sales price. So we're going to do our final check, and we are now good.